Right now, you can get a 5% guaranteed return by buying US government bonds. So is there any point in buying stocks which seem so uncertain? I mean, they could go up 5 to 20% or go down 5 to 20%. That's a great question. Let's find out in this video. So as all of you know, interest rates have gone up significantly, and that is fantastic news if you are a saver. So for example, if you buy a 3-month US government bond, which means you lend money to the US government, you get guaranteed 5.44% return a year. If you buy a 12-month government bond, you get 5.4% guaranteed return. And you could even buy a 10-year government bond and lock your money in and guarantee yourself 4.87%, or 30-year bond and guarantee yourself 5% a year for the next 30 years. On the other hand, there are no guarantees when you invest in the stock market, because in the short term, the stock market could go up, it could go down, it could go sideways, and there's so much uncertainty. So which is better? To put your money to something guaranteed 5% a year right now, lock it in, or put your money into the stock market where it seems so uncertain? Well, the answer depends on your time frame, and it depends also on your objectives. So the one thing to first understand about the stock market is that yes, it can be very unpredictable, it can be very uncertain in the short term. In the short term, anything can happen. The market can go up 5 to 20%, it can drop 5 to 20%. We have got no control over what happens in the short run. But over the longer term, 5 years, 10 years, 15 years, 20 years, the market always goes up. Why? Because on average, corporate profits double every 8 years. Because corporate profits always increase, the market always goes up. And of course, this refers to the overall index, like the S&P 500 index, which you could buy the ETF. It doesn't apply to an individual stock. If you buy the stock of a lousy company, it can drop and never come back, right? So I'm talking about buying the index via ETFs. For example, if you bought the S&P 500 ETF for the last 5 years, you'd have done really, really well. 5 years ago, if you put in $10,000 into the ETF and you held it through the ups and downs, after 5 years today, you'll be worth $16.9 thousand. So that's a 91% gain over 5 years. That translates to an 11.1% annualized return with dividends reinvested. Not too bad. And this is despite the market going through big crashes. We had a crash back in 2018. We had a huge crash in 2020, the COVID crash and a recession. We had a bear market last year with a banking crisis and high inflation, high interest rates. Despite all that crash, you're still up 91% in 5 years, or 11% a year. If you had invested for the last 10 years, $10,000 would have grown into $32,000, which is a 285% gain over the 10-year period. Again, that's a compounded annual return of 12.38% a year with dividends reinvested. And again, this is despite so many crashes in the market. We had a crash in 2015, crash 2016, crash in 2018, the COVID crash, the bear market. We had a bank crisis, inflation, interest, all the bad news, all the wars, and you're still up 12% a year. So the point is that in the short term, within say a year, stocks can be very uncertain, very unpredictable, and anything can happen. They can go up 5 to 20%, they can go down 5 to 20%. But over the longer run, 5, 10, 15 years, stocks will return in terms of the index an average of 10 to 12%. Now, of course, this is based on historical returns, the last 10, 20, 30 years, which is no guarantee of future returns. But in my personal opinion, I think that the next 10, 20 years will not only match the last 20, 30 years, I think the returns will be even higher because companies are growing much faster and they are more productive because of AI and automation. So going back to that first question, is it better to put your money into guaranteed 5% a year interest or to put into the stock market? And the answer is it depends on your time frame. In other words, when do you need to use that money? So if you need to use your money within the short term, within the next 12 months, you should never put it into the stock market. Why? Because in the short term, anything can happen, right? The stock market could drop 20-30% in the short term. And if you need that money in 12 months, then you should never put it into stocks. You should put it into bonds for a year or maybe 3 months, and then roll it every 3 months to guarantee that 5%. However, if you don't need the money in the short term and it's money that you're going to use in 5, 10, 15 years, and your objective is to grow your wealth and to beat inflation and to have enough to retire comfortably and be financially free from the rat race, then stocks would be a better place to put your money, because stocks would give you much higher gains than the fixed interest on bonds. So take a look at this chart. So you can see, for example, last year, 2022, was a bear market. And bear markets can happen anytime. No one can predict. And last year it happened. So last year, what happened? The stock market dropped over 20%. The S&P 500, you can see, dropped 20%. So over a 1 year period like 2022, if you had put your money into treasury bills, you can use this ETF called BIL to show you the treasury bill last year. Of course, if you put your money into treasury bills, then of course it's safer than buying stocks. It will ensure that in 12 months you have the guaranteed money to use for whatever you want, right? Where stocks, you lost 20%. Now, so for me, do I buy treasury bills? Yes, I do. I buy them using cash that I need in the short term. For example, in the next 12 months, I have to pay for the renovation of my house. I'm actually renovating my house in Singapore, which is very, very expensive, right? So I need a certain amount of money to pay my contractor in 12 months. So would I invest that money into the stock market? Of course not. Why? Because in 12 months, anything can happen. The market could drop 10, 20, 30%. It could also go up 30%, but I don't want to take that risk. So for that money, I have to put it into bonds or treasury bills, right? So that in 12 months, I know that guaranteed I'll get my money back plus 5%, pay my contractor. Yeah. But for the majority of my money that I don't need in the next 12 months, that I'm using it to grow generational wealth for my children, my family, right? Then I put into the stock market, all right? Because so you can see that over 5 to 10 years, for example, stocks like the S&P 500, even through all the recessions and crashes, they outperform putting your money into government treasury bills. Now, here's the thing. If you buy, for example, a 1 year treasury bill right now, right? You put your money into a US government bond, you're getting more than 5%. But here's the problem. Next year, it may no longer be 5%. So I expect that they are probably going to cut interest rates next year, or if not, the year after that. So you may get 5% this year, but in year 2, you may only get 4%. And year 3, only 3%. You get a point. So eventually, interest rates will go down. And if you just keep into these bonds, in the next 10 years, I don't think you can get 5% a year. You may, in the long run, only get 3 or 4%, which means that you may only just beat inflation, but you're not growing your wealth. Now, of course, you could buy a 10-year government bond and guarantee 4.8% for the next 10 years. But why would you want to get 4.8% a year for 10 years when you could get at least 10 to 12% return buying the index ETF? You know, I don't know, right? Only you can answer that question. So the lesson is this. In the short term, cash and treasury bills are safer than stocks. If you need money in the short term, keep it in cash and treasury bills. But in the long run, stocks are safer than cash and treasury bills, because in the long run, stocks will guarantee that you beat inflation and build your wealth. But treasury bills will guarantee that you may not even beat inflation or slightly beat inflation. So the longer you hold stocks, the safer it becomes. But the longer you hold bonds and cash, the more risky it becomes. So it all depends on your time frame. Again, this 10 to 12% annual returns from the stock market assumes you don't use your brain, assumes you just buy the index ETF without any stock picking. But if you learn how to pick the highest quality stocks in the market and you're patient, you buy them when they're undervalued, you sell them when they're overvalued. And this is what I do, right? So I teach my students to do what I do, which is we only buy the top 1% of the fundamentally strongest companies in the market. We buy them when they're undervalued, we sell them when they're overvalued. If you learn this skill, would you get more than 10 to 12% a year? Yes. So for example, if you take a look at buying the highest quality companies, if you look at my portfolio, most of my stocks are very, very high quality. For example, take a look. This is Microsoft, Apple, Amazon, Meta, and Google. So let's imagine you bought a portfolio of all these great companies. And if you look at the last 10 years, if you just put your money into treasury bills or bonds, you can see over 10 years, your money from $10,000 would have grown to only $11,000. That's only a 10% gain after 10 years. You can't even beat inflation. So that's why I say the longer you hold cash or bonds, the more dangerous it becomes, because it guarantees that you can never get out of that rat race. You'll never have enough to fund your retirement, right? If you just buy the ETF, S&P 500, without using your brains, then you would have gotten 182% return, where your money from $10,000 grows to $32,000, which is, again, not bad, not using your brains. But if you use your brains, you buy a portfolio of great companies, you would have gotten, okay, a portfolio of all these great companies. And if you take an average of all these companies, you would get roughly about 600% over that 10-year time frame, where your $10,000 grows to $75,000. So it pays to stay invested in the highest quality companies. Long run, there's a very high chance you're going to beat the index and beat cash and beat bonds. Now, besides time frame, it also depends on your objectives. For example, I've got some friends who tell me, Adam, I'm already rich and I don't need to grow my money anymore. I just want to get passive income and just live a simple life. So for example, I've got friends who say, Adam, I've got $5 million right now. And if I just put it into government bonds for the next 10 years and I'm guaranteed 4.8% interest, I can live off the interest, which is true. If you take 4.8% of $5 million, that's about $240,000 a year in interest, which is more than 20 grand a month. And you say, I can live on 20 grand a month, so I'm happy. And that's true, there's nothing wrong with that. And you say, Adam, I don't mind my 5 million not growing anymore, but I get 20,000 a month for the next 10 or 30 years. I'm pretty happy, right? But if I put that 5 million into the stock market, yes, the 5 million could grow into 10, 20 million, but I have to go through these ups and downs and my heart cannot take it, right? So it depends on your objectives. So there's a very old saying that stocks help you to grow rich, but bonds just help you to stay rich. So in other words, if now you already have 5, 10, 20 million and you don't want to grow it anymore, sure, just buy bonds. Get a 5% fixed interest rate, live off the dividends, interest for the rest of your life. You can do that, there's nothing wrong with that, right? But if you're not rich yet, you don't have 5, 10, 20 million, you only have a few hundred grand and you want to grow it to 5, 10, 20 million, then it's a stock market. So does that make sense? It depends on your time frame and your objectives and how strong your heart is. Remember, long run, stocks of great companies of the index will grow your wealth, but it doesn't go up in a straight line. There's always a catch in life. There's no free lunch in the world. So if you want to grow your wealth, the catch is you must be able to endure the short-term volatility and ignore all the negative news media, because that is what screws up people's mind and psychology to abandon their investment plans, so that in the long run, they never grow their wealth. So I hope you have learned something from this. If you have, subscribe to the channel and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.